Yeah, I think that now we start definitely. My name is Elizaveta Belugina, and I welcome everyone to our weekly Forex webinar, where we discuss the technical and fundamental outlook for the major currency pairs and sometimes other assets. Let's begin with our presentation. Just a second. Today we'll be discussing the main events of the past week. Of course, we'll speak about the US presidential election and try to analyze the consequences of this big event and how it will influence the market. We have already seen some of the impact of the US elections on the US dollar and other markets, and it is very interesting to make assumptions on whether we'll see continuation of these new trends or they are already at an end. Agenda for today is as usual. We discuss market positioning, economic calendar, technical analysis, and then summarize everything and share trade ideas. Let's have a look at the weekly data from CFTC, Commodity Futures Trading Commission. We can see that the aggregate US dollar long position has once again increased during the week, which ended on November 7th, I believe. US dollar position increased, and actually US dollar longs are now at the maximum levels since January. And it is interesting to say, however, that still dollar longs are only half of the levels which were recorded last year, and it means that US dollar bulls are still capable to push the currency higher. We can see on the daily chart of the US dollar index, which tracks the dynamics of the American currency versus the currencies of America's main trading partners, that the US dollar has opened this week with a gap to the upside and actually tested 100 points mark, which is an important resistance. We saw that this level acted as an obstacle for the American currency for now. There is the gap, and sometimes the gap is a signal that the market is getting ready to reverse. Sometimes the gap is a signal that the trend is so strong that it is going to continue to upwards in this case. As for this gap, it was formed at the important resistance level. We saw that US dollar went above October highs, and then this gap appeared. And as we are still below 100 points mark for the US dollar index, I think that we need a confirmation of US dollar closing above 100 mark to be sure that the trend is continuing and that we'll see further gains of American currency. Some correction is likely at this point to close this gap, and the gap opening, the gaps lower levels will be a support in this case. And of course, this long lower shadow, which we see was formed on Wednesday's daily candle for the US dollar index, is a kind of support for American currency. Such long pin bar candles push the currency to the upside, because we see that the bears were not able to make the pair close at the lowest point of this candle, and the situation reversed to the upside. The pair closed rather high, and it was strong bullish market, which was followed by a gap. So for now, it signals to me that this bullish trend in the US dollar is rather strong, but as a conservative trader, I would like to wait for the confirmation and for the break above $100 100 point mark, especially taking into account that currently we are not far from this level. Let's have a look at the economic calendar. What important events are there to trade on this week? On Tuesday, we'll see the release of British inflation data and inflation report hearings and US retail sales. On Wednesday, there will be labor market data from the United Kingdom and also another piece of statistics from the US, producer prices and industrial production. On Thursday, we'll get the info from Australia. Labor market data are especially important for Australian dollar. And then there will be British retail sales, US block of statistics, which includes building permits, CPI or consumer inflation, Philadelphia Fed Manufacturing Index, unemployment claims, and Federal Reserve Chairwoman Janet Yellen will testify to the Congress about the Fed's policy. On Friday and actually on Monday, later today, we'll hear from the ECB President Mario Draghi and FOMC member Bullard, and there will be Canada's CPI. So this is the agenda for this week. We see that no major events like the US election will take place. There will be a lot of statistical releases from America. Also, there will be quite many pieces of data from Britain and some comments from the heads of key central banks like the ECB and the Federal Reserve. As for the Federal Reserve, when everyone was just preparing for the US election and the main scenario which was expressed in the mass media was that Hillary Clinton would win the election, traders said that if Clinton wins, we buy the US dollar, and if Trump wins, we sell the US dollar, because if Clinton wins, then the Federal Reserve will surely raise rates in December, and if Trump wins, then the Federal Reserve's rate hike will be out of question because the situation will become too uncertain and the Federal Reserve won't act. However, the sell-off of the US currency on the news that Donald Trump was elected the US president was very short-lived. We can just return to this US dollar index chart and to see that this candle, or we can just have a look at the euro dollar daily chart and see that after the spike to the upside, after the initial decline of the US dollar, then the currency gained and was gaining since then. So the thing is that US dollar actually started gaining after Donald Trump was elected president, after it was announced that he has enough votes of the electors to become president. And we now see that the market still expects the Federal Reserve to raise rates in December. The market's perception has very quickly changed, and it seems that investors remembered that Trump has called for a rate hike. He criticized the Fed for leaving rates at the low levels and thus creating financial bubbles and increasing wealth inequality. And also, Trump delivered some soothing comments on infrastructure spending and tax cuts in his victory speech. And in general, he didn't dwell on trade restrictions and immigration policy in his victory speech. And somehow he managed to reconcile the market and to make traders really optimistic. We see that according to the federal funds futures, the probability of December rate hike is above 80%. And if we look at Wall Street Journal survey of about 60 economists from the major banks and other entities, we can see that here also more than 80% of the surveyed people think that the Federal Reserve will increase rates this year in December. It seems that the market has now almost fully priced in December rate hike by the Federal Reserve. The market is so is in a kind of rush at the moment, buying the US dollar, selling bonds. We saw that US Treasuries, 10-year Treasury yields rose to the highest level since January. Also, traders are selling emerging market assets and bonds especially. And according to Bloomberg, the decline in the bond market capitalization of the world bond market has declined by about $1 trillion during the past week. The thing is that investors all over the world think that Donald Trump will make a rather simple policy decision, that he will just increase spending on infrastructure and other projects. And this increase in spending will provoke a rise in US inflation, and as a result, people think that it's not wise to hold bonds which have fixed incomes and low yields. They sell government bonds. As a result of this selling, the price of the bonds goes down and the yields of the bonds go up, and high yields increase demand for the US dollar as a currency. The expectations that the Federal Reserve will raise rates and make America actually third central bank among the developed economies with highest interest rates also increases demand for the US dollar. So basically what is happening now, there is a rush, a trend to buy the US dollar on the expectations of higher inflation everywhere in the US and maybe even in other countries, and the US dollar is a kind of good bet, taking into account that American economy should benefit from this increase in government spending. Of course, this projected policy of Donald Trump still looks very controversial, and actually I think that this trade to buy US dollar won't do the market players any good in the long term and maybe even in the medium term, because on the one hand, higher treasury yields increase the pressure on the US economy. It makes it's more expensive for the US government to borrow money, and surely the Federal Reserve will see the risks which are associated with higher US debt cost and higher yields on US bonds. So the Federal Reserve may be not so eager to raise rates. After all, they have made a lot of effort to keep US yields at the low levels, to keep US rates at the low levels, and now this is being challenged. Such approach is being changed. In addition, we know that Donald Trump's trade protectionism is a kind of dangerous policy, and all of this together can really hurt US economic growth and increase the market's risk aversion. So for now, maybe during this week, this trend to buy US dollar to look for higher yields may continue, but in the medium and longer term, safe haven assets may once again become popular. If we return back to the economic calendar, it will be very important for the US data to confirm that US economy is on solid footing and it is ready for higher rates. And also it's very interesting how the Fed's chairwoman Janet Yellen reacts to this change in the nation's political environment, and whether she emphasizes that the US economy needs higher interest rates, or she tries to be more cautious. A more cautious approach of Yellen will be a very negative signal for the US dollar, which is becoming overbought, while her desire to raise rates will strengthen the current bullish trend in the US currency. Earlier last week, Vice Chairman of the Federal Reserve, Fisher, said that inflation and employment have moved closer to the central bank's targets, and the Federal Reserve is now more ready to raise interest rates. So his comments were rather positive to the US dollar. Also, if we look at the statements of the ECB President Mario Draghi, it will be very interesting to see what he has to say, how he will react to the US election outcome. And for now, the situation has become rather favorable for the ECB and the Bank of Japan, because their currencies depreciate versus the US dollar and thus decrease the pressure on the central banks to ease monetary policy further. And let's now move to the charts to discuss the technical picture and some more fundamental moments which we have to pay attention to for the individual currencies. As usually, we start with the weekly chart. And here we can see that last week there was a big bearish candle with a long upper shadow. We saw that this 100-week moving average, which is currently located around 1.1120, prevented the pair from getting higher and trying to change this more or less sideways dynamics with a negative bias. This line proved to be a resistance once again. And this resistance level still stands. It's still actual and in place for any attempts of the euro to get higher once again, to return to more positive, more expensive levels. All in all, we see on the weekly chart that for a long time the volatility in euro dollar was rather low, and there was a lack of trend directional movement for a long time. And many analysts now say that it's been too long since euro showed us a good directional trend dynamics, that it's time for this sideways trading to change and for the pair to go in one direction. And the direction the most analysts choose is to the downside. There are reasons to believe so. We see that last week's candle has closed below the candles of October, and this week we have renewed minimums, and the pair actually fell to the lowest level since November 2015. So euro dollar has reached 1 year minimums. This is what we can say from the weekly chart. So here the setup looks pretty negative. Let's move to the daily chart. At the daily chart, we can see that the pair is currently a bit oversold, as stochastics indicator tells us, and there may be minor corrections, minor recoveries to the upside. All in all, we have outlined last week the fact that the 50-day moving average has moved below 200-day moving average and then below 100-day moving average, and this bearish signal has paid off, and it managed to forecast the upcoming decline of the single currency. Of course, the election day, as a great news and great volatile event, has made some corrections. Euro tried to get higher, but closed the day below these resistance levels of the moving averages, and ultimately chose its direction and decided to go to the downside. All in all, if you traded without some kind of stops or risk management, then it should have been a crazy day for you, because really this spike in one direction and then the reversal to another direction was a kind of very nervous event for traders. Still, the inability of the pair to stay above 1.12 showed that there are a lot of sellers of the euro and buyers of the US dollar, and the pair is not really capable for any strengthening here. Resistance around 1.1160, 1.1120 looks very strong, and in my opinion, the euro will be sold on its attempts to recover. Also, I have my favorite weekly pivot indicator here. The euro is currently trading below the pivot line at 109.93, and as long as it's staying here, it means that the bears prevail, and the picture is bearish, with the pair tending to move towards their weekly support levels, support 1, 2, and 3, which are located at 106.86, 105.21, and 102.14 respectively. I don't think that the decline of the euro will keep on being that rapid as it used to be, but the gradual decline to the levels I've mentioned, especially in the first two, is very likely. Resistance is currently located around 108.40. This is the previous minimum, October minimum, which is now acting as resistance, and the weekly pivot level at 109.93. If we talk about the euro area's fundamentals, then they can say that last week they weren't perceived by the market as important. The main driver was the US election, and any news from the euro area were overshadowed by the American events. We will be hearing Mario Draghi's words this week. If he says that global risks have increased after Trump's victory, then the euro will likely go down as traders will expect some more action from the ECB. But I don't think that Draghi will give us too much negative thoughts because the euro has already declined far enough, and it may be enough for the European Central Bank just not to give the market any new information. The Eurozone's final CPIs for October and the accounts of the latest ECB meeting will be released on Thursday. And also, we'll hear about Germany's and the euro area's GDP for the first quarter on Tuesday. In addition, there is a lot of talk about the fact that Trump's victory in the US election has increased political risks for the euro area. The market has now increased fears about Italy's referendum, which will take place on December 4th. This is a constitutional referendum which will take place in Italy, and we can't say that the agenda of the referendum, the questions asked to the Italian public are kind of critical for the country. But as the nation's Prime Minister Matteo Renzi has said that he will resign if the project of reform which he has proposed won't be accepted during the referendum. This referendum becomes more like a proxy for Italy's staying in the European Union. So if there is a no vote at the referendum, then the market will probably be in a kind of disarray, and the euro will plunge on the expectations that new political forces will come to power in Italy and will make the nation leave the European Union and the euro area. So ahead of this referendum, political risks and this topic will be still discussed. According to opinion polls, the no vote, so the risk scenario for the euro, is more popular than the yes vote. So this is additional negative factor for the euro dollar, which will make the pair reach our targets at 106.86 and 105.21. Let's also have a look at the 4-hour chart. Here we can see that the moving averages are sloping to the downside. The 50-period moving average didn't cross 200-day moving average, period moving average to the upside. It turned lower, and the intersection with 100-period moving average, which is currently located around 109.70, will be a negative signal and will make the pair renew minimums. For now, as we have outlined, some recovery to the resistance area at 108.50 is quite possible, as the pair is oversold and there is kind of divergence here in stochastics. Let's now look at the British pound, and we can see that the picture is quite different from what we see in the euro dollar. Firstly, the weekly chart. Here we can see that GBP USD tested support at 1.23 1.2350, somewhere in this area. Let's put this level on the chart. But then GBP USD managed to close last week on the positive territory, on the bullish territory. The close was around 1.26 mark, slightly below this level. We don't have a very big bullish candle, but it's still bullish, and it is a sign of strength, relative strength of the British pound. Levels around 1.2840 are still quite attainable if we have good data from the UK and weaker data and dovish statement from the Federal Reserve. The pair is now a bit on the downside on the daily chart and testing support around 1.25. All in all, we can see that on the daily chart, the moving averages, 50-day moving average, 100-day moving average, and 200-day moving average, are still in the order of the bearish trend, which they have been for a long time now. And the first moving averages, 50-day moving average, which the price has managed to touch, is now providing resistance around 1.2655 mark. This line is also declining, and it still means that the overall trend for the British pound is negative, and we still need for the British pound to get higher, probably above 1.2850, to signal that a change in this trend is starting to materialize. For now, we don't have this signal. If we look at the daily chart, we can also see that the pair is currently having support of the short-term bullish trend, and this support lies around let's have it on the 4-hour chart better. This support lies around 1.2435. Also at the 4-hour chart, we can see a bullish intersection. The 50-period moving average went above 200-day moving average, and as long as GBP USD stays above this trend line, we have the chance for the pair to return to its highs around 1.2670 and make a go on 1.2840 level. Why is British pound is performing so much better than the European currency, the euro? The thing is, as S&P Global puts it, that the British pound is still extremely undervalued. There is a difference between domestic and foreign yields is actually in favor of the sterling. And after Donald Trump was elected and traders started looking at their bond yields as the main driver of the currency market, then the market's attention returned to the yield differentials, and GBP USD went up. In addition, I propose to remember the previous positive factors, like the UK High Court ruling on Brexit, and in my opinion, these factors still support British currency. The UK economic data have been rather solid. Higher price pressures make it more unlikely for the Bank of England to keep cutting interest rates or doing more stimulus, and that's why British pound finds itself in a rather favorable condition. British pound doesn't actually have a driver for a very rapid increase, for a big spike. But as we can see, both from technical and fundamental points of view, there is chance for some increase in this currency pair, some smooth increase, let's say. Also, we can have a look at euro pound pair, and here we can also see that the British pound is recovering ground versus the euro. The previous decline of the British pound after Brexit may have been overdone, and now the British pound is conquering back its positions. On Friday, the pair managed to close below 100-day moving average, which is located at 0.8619, and now the pair has a fairly good chance to go lower to the area of 0.8425. Resistance is located at 0.8620 and a bit higher in the area of 0.7615 and 0.8760. So this is what we have about the British pound. Now we move to dollar-yen currency pair. And of course, the US presidential election had a great impact on dollar-yen. Despite the fact that Trump's victory had been seen as an extremely risk-negative outcome and should have increased demand for the Japanese yen as a safe haven currency, this demand for the yen was extremely short-lived. We can see the spike in the pair as we have seen a spike in the euro dollar to the upside and in the US dollar index to the downside. Here we can also see this spike to the downside for the dollar yen. The pair tested minimum at 101.19 before getting higher. And in its way to the upside, the pair managed to break above a resistance line, which was drawn through maximums of September and October. This line also provided support on Friday, and the pair managed to rise above 200-day moving average and get as high as approach 108 mark. Let's have a look at the weekly chart, because sometimes weekly charts do provide us important hints. And here, we can see that stochastics indicator is in a very overbought area, and also we are really close to important resistance, which is located in the area of 108.40, 108.50. Let's mark this level with a red line. The negative intersection of the weekly moving averages can come into place, and despite the fact that the bearish Shimoku cloud we have on the weekly chart has started contracting, it's still bearish, so we still have to pay attention to this resistance level. So returning to the daily chart, we can see that we are very close to this resistance mark. Also, we can use a Fibonacci instrument to make a projection of important levels of retracement, and we can see that at 109.20, somewhere here, we have 38.2% Fibonacci retracement of the pair's decline in 2015-2016. So we are approaching a resistance area between 108.40 and 109.20. On the daily chart, we can see that the Ichimoku cloud is still very thin, and that the bulls don't have kind of really impressive strength at this daily time frame. Also, the Ishimoku has made a bearish cross the Tenkan-sen and Kinjun-sen lines. And despite the fact that the 50-day moving average is above 100-day moving averages, still we can see that the pair's advance should slow down and the pair should probably visit lower levels before it is able to overcome the resistance area we have drawn at this chart. I'd like to look at RSI indicator as well. It is in indicators, oscillators, and relative strength index. Yes, and as we can imagine, it is as well in the overbought area. So a signal that this advance of dollar yen was too rapid, and now we need some kind of rest, some kind of retracement here. All in all, the recent developments were very welcome by the Bank of Japan because on the US election day, Japanese authorities have commented that the Forex market moves are becoming too dangerous and there may be a need to intervene for the Japanese authorities. But then as dollar yen went higher, such need has dissipated. So I think that levels around 106, 105.50 maybe can be attractive for more US dollar long positions because the markets will still expect the Federal Reserve to raise rates, and in the medium term, I think dollar yen can test higher levels, can test levels around 50% retracement of 2015-2016 decline, and these levels look rather reasonable for now. But probably this week we'll see a kind of a slowdown in US dollars expansion. Let's have a look at the pivot indicator for dollar yen. The weekly pivot point is located at 104.90. Above this level, the outlook for the US dollar Japanese yen will remain positive, and resistance levels provided by the indicator are located at 108.67 and 110.68 ahead of 114.40. But this level looks still far away, and I don't think that we have it on the agenda this week. Support is located at 104.90 and 102.91, but earlier we'll have support level at 106.50. This is 200-day moving average. On the 4-hour chart, we see that the moving averages are starting to slope to the upside and have a bullish intersection, but they are kind of far away from the current price, and they welcome a return to the lower levels before the increase continues. And the indicators on the 4-hour chart also show that the pair is too overbought. Let's now have a look at some of other currencies, for example, Australian dollar, US dollar, which represent commodity currencies. The pair has made big swings during the past week. It rallied to the highest levels since April, above 0.77, as markets were pricing in Hillary Clinton's win. Then, on the victory of Donald Trump, the pair slumped to the downside and actually closed below the main support line on Friday, which is located at 0.7550. This support line goes back to the beginning of 2016. And we are now seeing that the market is, of course, trying to return above this support line, but the attempt doesn't look very convincing, and the pair looks vulnerable for decline to 0.7490 and 0.74. The moving averages on the daily chart, 100-day moving average at 0.7590 and 50-day moving average at 0.7615 are horizontal. They mean that the decline of the Australian currency probably will be slight from now on and won't be very extreme. But still, these lines, though horizontal, represent now resistance levels, which will make it harder for Australian dollar to recover. All in all, Donald Trump trade protectionism makes the picture for commodity markets and commodity currencies more negative. In addition, Australian dollar is closely tied to China and trade with China. And China is really vulnerable and really uncertain right now, as Donald Trump has expressed intention to call the nation currency manipulator and somehow deal with China's trade with the US. So it doesn't seem that Australian dollar has a good external environment right now. The picture is rather bearish, and the only thing which is keeping the currency supported is the relatively good Australian economy. The fact that the Reserve Bank of Australia kept rate unchanged at 1.5%, and the fact that all in all, traders all over the world are currently looking for high yields, and Australian dollar does provide high yield, but it is associated with risks. And for now, we see that traders do choose the US dollar versus practically all major currencies. So we'll be looking for more declines of Australian currency, but not rapid declines, and we have these two support levels to watch. As for the economic data from Australia, we will have Australian labour market releases, which should be important, and also news out of the US and comments by the Fed Chair Janet Yellen will be important for the dynamics of Australian currency. Canadian dollar is another currency which suffered from the US election outcome, and actually it looks rather bearish. We can draw a line here, and clearly there are some pattern broken in USD Canadian dollar. We see that The moving averages on the daily chart show us bullish picture. If you look at the weekly chart, also the pair has breached this triangle and is ready to conquer new levels. Currently, we have some resistance at 50% Fibonacci retracement of this year's decline. But in my opinion, if we manage to close above this mark, our next target will lie above 1.38, and taking into account lower oil prices, the risks to oil prices which are associated with the meeting of the Organization of Petroleum Exporting Countries later this month, taking into account the fact that Donald Trump is going to push some changes into trade arrangements between the US and Canada. And all in all, that commodities suffer from the news from the United States. In my opinion, this scenario is very likely that we will move above 1.3575 to levels above 1.38 for the US dollar, Canadian dollar. Of course, we see that stochastics is really stretched on the weekly chart, but nevertheless, we have new support levels located at 1.3440, 1.33, and these levels should provide support for the pair. They should provide us good places to buy US dollar, Canadian dollar with targets at 1.3575 and 1.38. And as for gold, it is suffering right now. It has plunged to support line drawn through the minimum of June and one of the lowest points, local lowest points of February. The support is located just above 1,200, and actually looking at Fibonacci of the 2015-2016 advance in gold, we are currently at the 50% retracement here, providing some support, and a decline below this level will provoke a new sell-off, and levels around 1,170 and probably lower will be on the table. In my opinion, there is a chance that the market will stay above this line because still risk aversion is created by Donald Trump. The fear of inflation is now stronger than the risk aversion, so traders don't buy gold, and the recoveries will meet further resistance in the area of 1,248, 1,250, and in my opinion, it's too early to buy gold at this point, but the decline to 1,170 and maybe to the next Fibonacci level should provide opportunities for buying gold, as traders will probably start fearing of Donald Trump's policy in a month or maybe in several months. We know that Donald Trump will start acting as the US president around 20th of January next year, and by this time the market may have priced in all the concerns about the US inflation and start trading on the risk aversion concerns. And this would be the time to buy gold. For now, the picture looks more bearish, and more selling will likely happen on the attempts of gold to get higher and to return to October minimums. This is it for today. Let's now quickly summarize what we have talked about. All in all, we have a new reality, political reality in the US and maybe in the whole world. After Brexit, after Trump was elected US president, traders now fear of some unexpected outcomes. They fear that more nationalistic and protectionistic governments will come to power, and the risks of political uncertainties has now certainly increased. The main driver of the market is now fear of high inflation in the US because of the policy of higher fiscal spending planned by Donald Trump. And we expect these expectations to continue driving the market for some time ahead. There will be minor corrections in the US dollar, but still it looks like the Federal Reserve will raise rates in December. This is the main scenario what the market is preparing for, and this scenario looks rather credible. Of course, we will need to look at the US economic data releases. We have plenty in the economic calendar this week, and at comments by the Fed's head Janet Yellen. These comments will create volatility this week, but still traders for now will keep hedging from high US inflation and will have money in cash, will buy the US dollar versus currencies like Japanese yen and the euro. We have spoken about technical levels, and such pair as euro dollar is vulnerable for further declines as long as it stayed below October minimums at 108.50, and the downside targets include 106.86 and 105.20. For the British pound, the picture looks a bit more bright, as the currency still looks undervalued after Brexit. There are some positive technical signals, and as long as GBP USD is trading above 1.2430, it still has possibility to return to levels around 1.26. Dollar yen has reached an important resistance level, has almost reached resistance area of 108.40. These are the moving averages on the weekly chart, so be careful with long positions right now. It may be wise to wait for a bit of a retracement to enter the market with bullish positions. And as for Australian dollar, it has broken support line of 2016, and it makes us look for lower levels. But also here we don't think that the movements will be as strong and as volatile as we have seen last week. Currencies like Canadian dollar are vulnerable to the US dollar, and we will likely see US dollar Canadian dollar around 1.38 in the coming month, I would say. This is it for today. I thank you for your attention. As usually, I wish you to have a good trading week and a profitable one, and to use this information in trading. We'll see each other in a week. Next Monday, we will discuss our outlook for this week, what was successful, what was not, and make a new plan for the new week. Thank you for your attention. All the best, and we'll see each other in a week. Bye.